Ever wonder why cryptocurrency prices swing so wildly? You're not alone. Cryptocurrency, a form of digital or virtual currency that uses cryptography for security, is inherently volatile. This means that the prices of cryptocurrencies like Bitcoin or Ethereum can dramatically rise or fall in a very short time. But what causes these wild swings? Well, there are several factors at work. Market sentiment, or how investors are feeling about the overall market, can cause dramatic price changes. If investors are feeling positive, prices can soar. But if they're feeling uncertain or negative, prices can plummet. Regulatory news, or changes in how governments around the world are regulating cryptocurrencies, can also cause volatility. Technological changes, such as updates to the blockchain technology that underpins cryptocurrencies, can also impact prices. And let's not forget market manipulation, where big players in the market intentionally drive prices up or down. Understanding this volatility is the first step in protecting your cryptocurrency investment. So, what exactly is market volatility? Well, let's dive into that. Market volatility refers to the degree of variation in the trading price of a financial instrument over time. In simpler terms, it's the rate at which the price of an asset, in this case, a cryptocurrency, increases or decreases for a set of returns. Cryptocurrencies are notoriously volatile, meaning their prices can swing wildly in very short periods. This can lead to significant price changes, and as any seasoned trader will tell you, this volatility can lead to high rewards. But how can we measure this volatility? This is where the concept of a volatility index comes into play. A volatility index is a tool that measures the market's expectation of future volatility. It essentially gauges the mood of the market, providing a forecast of the likelihood of changes in the market. A high volatility index indicates a market that is expected to fluctuate greatly, while a low volatility index suggests a more stable market. Now you might be thinking, high volatility sounds great, more potential for significant returns, right? Yes, but it's important to remember that with high volatility also comes high risk. The same rapid price changes that can lead to significant gains can also result in substantial losses. In the world of cryptocurrencies, where prices can skyrocket one moment and plummet the next, understanding and keeping an eye on market volatility is key. It's like the pulse of the market, giving you an indication of its current state and a hint of what might come next. So, to sum up, market volatility is the degree of price variation of a trading financial instrument over time, measured by a volatility index. High volatility can mean great potential for reward, but it also comes with high risk. It's crucial to understand that volatility is a fundamental aspect of the market, a double-edged sword that can cut both ways. Volatility is a double-edged sword. It can bring great rewards, but also significant risks. So always remember to monitor the market's pulse. And as always, trade wisely. How can you measure market volatility? Well, let's dive right in. There are several common measures of market volatility that investors use to gauge the risk and return trade-off. Two of the most popular are standard deviation and average true range. Standard deviation is a statistical measurement that sheds light on the historical volatility of an investment. Simply put, it measures how much a set of returns deviates from its average. A high standard deviation indicates a high degree of volatility. This means the price of a cryptocurrency has swung dramatically in a short period. On the other hand, a low standard deviation suggests that the price has been relatively stable. Now let's talk about average true range, or ATR for short. This is a technical analysis indicator that measures market volatility by decomposing the entire range of an asset price for that period. In simpler terms, it helps determine the average change in price during a given period. A higher ATR indicates a more volatile market, while a lower ATR suggests a less volatile market. So how can these indicators help you as an investor? By understanding these measures, you can better assess the risk associated with your investment. For instance, if you're a risk-averse investor, you might prefer cryptocurrencies with a low standard deviation and ATR. However, if you're more of a risk taker, you might find opportunities in cryptocurrencies with high volatility. Keep in mind, though, that these measures should be used as part of a broader investment strategy. They are tools to help you make more informed decisions, but they are not foolproof. Other factors such as market news, economic indicators, and even global events can also impact volatility. In the dynamic world of cryptocurrency, understanding market volatility can give you a significant advantage. It can help you anticipate potential price changes and make strategic decisions. Remember, knowledge is power, and in this case, it can also mean the difference between profit and loss. Measuring market volatility is critical for managing risk and maximizing your returns. Now, how can you protect your cryptocurrency investment against volatility? That's a question that's likely on the minds of many. Well, there are several strategies that you can implement to shield your investment from the unpredictable swings of the crypto market. Firstly, diversification. Yes, you've probably heard this one before, but it's worth repeating. Don't put all your eggs in one basket, as the saying goes. By spreading your investments across a variety of cryptocurrencies, you reduce the risk of a single coin's volatility drastically affecting your portfolio. It's like hedging your bets. If one coin does poorly, another might do well, balancing out your potential losses. Next up, dollar cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of the price of the cryptocurrency. So whether the market is up or down, you continue investing the same amount. Over time, this method can reduce the impact of volatility on your investment, as you're buying more coins when prices are low and fewer when prices are high. It's a disciplined approach that takes emotion out of the equation, helping you avoid impulsive buying or selling based on market swings. Lastly, consider using stop-loss orders. This is a tool that automatically sells your cryptocurrency when it reaches a certain price. By setting a stop-loss order, you can cap your potential losses if the market takes a downturn. It's like having a safety net, protecting you from significant losses. But remember, these strategies are not foolproof. Cryptocurrency is inherently volatile, and there's always a degree of risk involved. What's crucial is having a well-researched and disciplined investment strategy. Stay informed about market trends, make calculated decisions, and don't let fear or greed drive your actions. Implementing these strategies can help you navigate through the choppy waters of cryptocurrency volatility. And while the seas may be rough, with the right strategies, you can sail through with confidence. Let's recap what we've learned today. We started off by delving into the concept of cryptocurrency volatility. It's that roller coaster ride of price changes that can make your heart skip a beat. We learned that this volatility is not just a random event, but a feature ingrained in the very fabric of the cryptocurrency markets. It's the result of a multitude of factors, from market sentiment and investor behavior to regulatory news and technological advancements. We moved on to understanding market volatility. We learned that it's a measure of the rate at which the price of an asset, in this case a cryptocurrency, increases or decreases for a set of returns. Volatility is typically measured by the standard deviation of the returns over a certain period. It's this very volatility that makes the crypto market exciting and potentially profitable for traders and investors. Then we delved into how we can measure this market volatility. We saw that there are several ways to do this, including using historical price data, the Moving Average Convergence Divergence, MACD, and the Relative Strength Index, RSI. We also learned that there are volatility indices that provide a real-time measure of market expectations of volatility, such as the Bitcoin Volatility Index. Next, we moved on to strategies to protect against volatility. We learned that diversifying our portfolio, setting stop losses, and hedging with derivatives can help mitigate the risks posed by market volatility. We also emphasized the importance of having a clear investment strategy and sticking to it, even in the face of dramatic price movements. But remember, these aren't the only strategies out there. There are a plethora of other protective measures and tactics that seasoned investors use, and it's highly recommended that you continue to research and learn about them. It's also crucial to stay informed about market trends. The cryptocurrency market is a rapidly evolving space. What worked yesterday might not work tomorrow. Therefore, it's essential to keep a pulse on the latest news, regulatory developments, and technological advancements. Lastly, don't let the fear of volatility deter you from exploring the world of cryptocurrencies. Yes, the market can be turbulent. Yes, there are risks. But remember, with high risk can come high reward. The key is to understand the market, stay informed, make smart decisions, and always have a plan. Remember, understanding volatility and having a solid investment strategy is the key to protecting your cryptocurrency investment. Until next time, stay savvy in the world of cryptocurrency.